0.01% on $10,000. That is $1 a year. $1, 4.0, 3%, same $10,000. $403, same year, same economy, same country, same FDIC insurance. The only difference is where the money sits. The Federal Reserve held interest rates at 3.50 to 3.75% on the 18th of March, 2026. Second consecutive hold, no cut on the horizon until at least June. And even that is not guaranteed. While the Fed holds, every high-yield savings account in America also holds. The rates have not dropped, not yet, and until the Fed moves, they probably will not. The national average savings account rate per the FDIC as of March 2026 is 0.39%. That is the average. The floor is lower. Chase pays 0.01%. Bank of America pays 0.01%. Wells Fargo pays 0.01%. Three of the largest banks in the country, same rate. The same rate they were paying when the Fed was near zero. The same rate they were paying when the Fed was above 5. The rate does not move because it was never designed to move. There is a person somewhere in Indianapolis right now, a 29-year-old doing claims processing for an insurance company, making about $54,000 a year. They have $11,200 in a Chase savings account. They opened it in college because the branch was next to campus. They have never moved it. That account earned them $1.12 last year. The same $11,200 in a high-yield savings account at 4.00% would have earned $448. The difference is $447. Not because this person did anything wrong, because nobody told them to look by any reasonable definition. This is exactly the kind of person the banking system is supposed to serve. Here is what it offered in return. $1.12. You checked your savings balance sometime in the last 2 weeks. Probably on your phone, probably while you were doing something else. You looked at the number. You did not look at the interest line. Almost nobody does. Here is what a side-by-side actually looks like when you line up the numbers that matter. Vio Bank online only, 4.03% AP as of April 2026 per bank rate. No minimum balance to earn the rate. $100 to open, no monthly fee, FDIC-insured. Lending Club, 4.00% AP with their level up rate, which requires depositing at least $250 per month. If you do not meet that threshold, the standard rate drops to 3.00% AP. No minimum deposit to open, no monthly fee, FDIC-insured. Rates per Lending Club as of the 15th of April, 2026. Bread savings, 4.00% AP per Bread Financial, $100 to open. No monthly fee, FDIC-insured. They also offer CDs if you want to lock a rate, but the savings account is the relevant product here. Open Bank, 4.00% AP Pi per bank rate, $500 to open. That is the highest minimum opening deposit on this list. No monthly fee, FDIC-insured, digital subsidiary of Santander. Everbank, 3.90% AP as of April 2026 per EV Urbank. No minimum anything. No fee, FDIC-insured, also has checking. If you want everything in one place. Forbright Bank, 3.85% AP as of the 14th of April 2026 per Forbright Bank. No minimum, no fee, FDIC-insured. I want to be clear. I am working with publicly available numbers here. Not a licensed financial advisor, not telling anyone what to do with their money. These are the rates as posted by the institutions and third-party sources on the dates noted, but look at what these numbers actually say when you put them next to each other. The gap between the top of this list and the bottom is 0.18%. Vio at 4.03, Forbright at 3.85 on a $15,000 emergency fund. That gap is $27 a year. Not nothing, but not the story. The story is the gap between any of these and the bank you are probably using right now. Start with a $15,000 emergency fund. That is roughly 3 months of expenses for a household, earning $60,000. At Chase, 0.01%, that earns $1.5 in a year. At VioBank, 4.03%, the same $15,000 earns $604.5. The difference is $603. In 1 year, on the same money, doing the same thing, sitting in an account you never touch. Over 5 years, that compounds not dramatically because you are not reinvesting it into equities, but it compounds. $15,000 at 0.01% for 5 years. You end up with $15,007, rounding up. $15,000 at 4.00% for 5 years, compounded daily. You end up with $18,321. The difference is $3,314. That is not a rate of return on an investment. That is the cost of not moving a savings account. And the cost is real whether the money moved or not. Your emergency fund sitting in a big bank savings account, paying 0.01% is not being stored. It is being lent. The bank is lending your money out at mortgage rates, auto loan rates, credit card rates. They are earning 45, 6, 20% on your deposit. And they are paying you 1 cent on every $100 for the privilege. That is not a service. That is a spread. Here is the part most comparison articles skip. Not all 4.00% accounts are the same. The AP is one number. The experience of actually using the account is another. Withdrawal limits. The federal 6-transaction rule under Regulation D was eliminated in April 2020, but some banks still impose their own monthly withdrawal or transfer limits as a matter of policy. If your emergency fund is supposed to be accessible in an emergency, read the account terms and check whether the bank limits how often you can move your own money out. Transfer speed and 8, transfer from an online-only bank to your primary checking account. Takes 1 to 3 business days. Some offer same-day transfers. Some do not. If your car breaks down on a Tuesday and you need cash by Wednesday, this matters. Mobile deposit. Most of these banks have apps. Not all of the apps work well. Read the reviews. If the app crashes twice a month and you cannot deposit a check, the AP is irrelevant. There is a couple in their early 30s, both working in education, support roles in Raleigh. Combined income around $89,000. Renting a 2-bedroom. They have $22,000 saved for an emergency fund. It is sitting in a Wells Fargo savings account earning 0.01%. They are not financially illiterate. They budget, they track expenses. They just never question the account because it was already there. If they move that $22,000 to an account paying 4.00%, they would earn $880 in the first year. Instead, they earn $2.2. The difference of $878 is not life-changing money, but it is a round-trip flight. It is a month of groceries. It is a car repair they would not have to put on a credit card. They made the most common financial decision in America. They did nothing, and doing nothing has a price. The price is $878 a year, every year, quietly, with no notification. Now, here is the number underneath all the other numbers. The Bureau of Labor Statistics reported that the Consumer Price Index rose 3.3% for the 12 months ending March 2026. If your savings account pays less than 3.3%, your money is losing purchasing power every single month. It is in the account. The number on the screen stays the same, but what that number can buy is shrinking. At 0.01%, you are losing over 3% a year in real terms. That is not a rounding error on $20,000. That is roughly $660 in purchasing power gone in a year. The balance says $20,002. What it buys says something closer to $19,340. At 4.00%, you are ahead of inflation, barely, but you are on the right side of the line instead of the wrong one. That line, inflation rate on one side, your AP on the other. Every month you are below it, your emergency fund gets weaker. Every month you are above it. It holds. This is not about chasing yield. This is about whether your safety net is getting stronger or weaker while you sleep. FDIC insurance. Every account on this list is FDIC insured. That means $250,000 per depositor, per bank, per ownership category. If the bank fails, the federal government covers your deposit up to that limit. This is the same protection you get at Chase, the same protection you get at Bank of America. The insurance does not care whether the bank has a branch on your corner or only exists on a screen. The difference between accounts paying 3.85% and 4.03% is small enough that the deciding factor should not be AP. It should be usability. How fast can you get your money out? How good is the app? How easy is it to set up an external transfer? How annoying is the customer service if something goes wrong? The difference between any of these accounts and the one paying 0.01% is not small. It is 400 times larger. That is the decision that matters. One more thing, these rates are variable, every single one. When the Fed eventually cuts, again, these numbers will come down. Nobody knows when. Nobody knows by how much. But the 4.00% you see today is not a locked rate. It is a snapshot. What does not change is the gap. When rates drop, the online banks will come down, but the big banks will stay at 0.01. They always do. The spread between the available rate at online banks and the default rate at the big three has stayed wide through every rate cycle for the last 2 decades. The gap is structural. It is not going away. That line again, the inflation rate, your AP. Which side are you on? I am not telling you to do any of this. I am not a financial advisor, and this is not financial advice. But here are the levers that exist in the system right now, based on publicly available information. 15 minutes to open an account online. Most of these banks ask for a name, a social security number, and a linked checking account for the initial transfer. The transfer takes 1 to 3 business days. You do not have to close your old account. You can keep $50 in Chase and move the rest. The emergency fund does not care where it lives. It cares that it is accessible and that it is not shrinking. Every institution holding your deposit has a structural reason to keep you exactly where you are. The less you earn, the more they keep. None of them are going to send you a notification that says you could be earning 400 times more at an online bank. That is not how their math works. You did not know this, or you knew it and did not act on it. Either way, the number is the same and it does not change until you do. Your emergency fund is not broken. It is just parked in the wrong lot.